Hi, welcome to Market in a Minute, and welcome to the Trump tariff bear market. So, yes, we've fallen by over 20% from high to low on Monday, officially a bear market. So, you need to step back a little bit and kind of review what's going on. In just generally speaking, my investment philosophy is loss averse. So, that doesn't mean I don't like to make money because I love making money. But when things are risky, I like to protect myself. So we've managed this really well for our customers. We've protected capital well, and now we're kind of looking around at the opportunities. So the question you have to ask is, no, not the Clint Eastwood line, do you feel lucky, punk? Is how much risk is still in the overall market? So that's the question. So looking at the market in general, um, we've come to the conclusion that there's still some downside. So the tariffs, we got the bad news out. There still may be some bad news coming from China. You really have to wonder what China is really up to. Are they just being stubborn and proud by increasing tariffs as well? Or is there something else going on there? So on the geopolitical side, we're a little bit concerned about that. There's been some movement. Some of the military leaders in China are being moved around, or maybe they are just disappeared. I don't know. But there seems to be things going on, and I noticed that on Monday that the 10-year Treasury actually went up in yield. Maybe that there's more confidence now that all the bad news, or most of the bad news, is out on tariffs. Maybe the economy isn't as bad as expected, or maybe China is selling off this $760 billion they have in U.S. Treasuries. Don't know, but that's kind of the lingering risk in my mind out there. One of the lingering risks that's out there that could pop up at some point in time. So we do think that the economy will have 2 quarters of negative GDP growth, likely back to back. We think that this quarter, the first quarter, is clearly going to be down when it's reported. Second quarter might be, and I say might be, that's not a for sure thing. So we have our quote recession, and maybe it'll be a very mild recession. 2025 earnings. Okay, so if you look at the consensus, it's now currently $269 in S&P 500 earnings, and that's about roughly 18.8 times. So if you just look at that, that's a reasonable multiple now. So you have to back out all the high valuations from the AI, mega cap technology names, and you bring that multiple down by 2.5 points. So that gets you about 16 times earnings for the rest of those, for the S&P 500 in general. So if the what happens during a recession is you get a double hit. So if this is a nasty recession, which we don't think it is, you're going to get a hit to valuations, and you're going to get a hit to earnings. So it means the valuation has to come down. That's what happened in 2022. You can see from the chart here. The valuation of the S&P got almost to 15 times earnings. So we would expect the valuation to come down if we're having one of those typical recessions. If not, then maybe this is a reasonable valuation for the overall stock market. So the hit to earnings could be down to about $250, which would put the S&P 500 around 20.2 times earnings currently. And you take that $2.50 out, 2.5 multiple out of the multiple, you get roughly 17.5 times earnings. So that would be right around here on the multiple, which is obviously higher than what occurred back in 2022. So there is some multiple and some earnings compression that could be coming. Most bear markets take a while to play out. Most bear markets take about 9 months. So the news isn't going to be all bad uh, in a straight line. So if we continue to have bad news, then it's going to play out over time, and that there's probably maybe as much as 10% more downside. How we get to that downside of around 4,400, that's taking the 17 and a half times earnings for the S&P, which really equates to about 15 times if you adjust that for the AI valuations. And so that gets about 4,400 on the S&P 500 using $250 as the S&P 500 earnings. So that kind of gives you a framework that if the market, if the economy continues to weaken into maybe a nasty recession, that there's more downside risk. Remember what we're working with. We've got um, we've got the tariffs going on, and that was the catalyst. But we also had cutting of government spending that's coming, and then lower government spending because Biden's not here anymore. And so you've got these multiple things happening that's just going to naturally slow the economy down, and we're going to likely see some negative growth. And at this point, I think that's kind of, somewhat in the markets at this point. Now the technicals. So if you look at the S&P 500, um, we put some shorter term moving averages here so you can see how much we've dropped. So this is roughly the 5-day, and then the 13 and the 20-day are way up here. But we started to get defensive up here, right? When we started breaking the 50 and 100-day, we wanted to get out of the way of the decline. And then we got a oversold condition based on a counter and opportunity for a counter trend rally here. And so we played this, and then we couldn't hold the 200-day. So it rolled over more. And as we said last week, if you couldn't hold 5,500 on the S&P 500, then there was more downside. Look out below. And that's exactly what happened. There was no support in the overall market. So we really corrected down to a level that I think there is a little bit of support in the markets at this point. So really good support in the S&P 500. It's more like 4,600 and 4,200. Now look at the VIX. Here's the VIX. That straight line up, rather remarkable. So we're up about 48. That's where we got to, about 48 on the VIX. And you can see back in 2022, we didn't get nearly that high. That's a bear market, right? We got way up here. If you're using VIX as an indicator to time, and it works okay, if you use it as an indicator, this is a big buying opportunity. Now the oscillator is also nicely oversold. We didn't show that this week, but it's nicely oversold, and likely will start to drift back up, so it's not so oversold. So we're thinking we're going to see some upward movements in the overall markets if there's maybe a series of good news coming out from the tariffs, or maybe the news just goes away for a while. The negative news goes away. We think that the market will start to drift higher. And actually, when there was some positive news on Monday, it turned out to be false news on the tariffs. The market shot up in a big way. So we think it's prone to, maybe a counter trend rally, and a counter trend rally to be stronger than what it was here. So we're thinking that maybe it's possible to see this rally up to the 20-day or even up to the 200-day moving average to get maybe a double-digit sort of return in a market that's in a downward sloping pattern. In terms of wealth management, so we've done a really good job avoiding this downside. I'm really pleased. I feel like we do a good job, and anytime we get these bear markets or significant declines, we do a really good job in protecting capital by hedging those portfolios and or using stop losses. So in the process of hedging, we also want to cleanse the portfolio as it goes down. As better names emerge, we want to get out of some of those names that we maybe don't like as much as the names that have come down in a big way. So, use stop losses in your strategies or hedging. I think it's really appropriate. We kind of went over the hedging before and other videos, but remember, as you break those moving averages, you want to become incrementally more defensive, and by hedging the portfolio, that's a nice way of doing it. So stock picking has helped greatly as well. So at this point, we're looking at, okay, what are the great companies out there that have really pulled back? And then what are the future great companies? So the great companies, hard to argue that Amazon's not a great company. It's roughly now at 25 times earnings, and they may be impacted a little bit from the tariffs, right? Not to any great degree, but they will see some impact. And then Meta, I really like the fundamentals of Meta. Meta's fundamentals have improved. Really like the whole model of what they're doing. And this is roughly 19 times earnings. So Meta now trades at a discount to the overall market. It's going to grow a lot faster, huge cash flows. I think next year all these guys are going to be spending maybe a lot less, but less on the AI infrastructure. Google has some exposure to their core base of search, but we haven't seen it, much of that market share loss on search with them at this point. But that's the risk as AI becomes more and more prevalent. Maybe some of that search moves over to other competitors. That's I'm sure what Amazon and Meta are trying to do. But we like that one at 15 times earnings. So that could easily be a over 20 times multiple, and versus the overall market, I would much rather own Google. And then some of the great companies to come. Let me talk about Anavex first of all. So there's a research company that put out a report. I thought it was really interesting that they think there was a 90% probability of a positive approval on their Alzheimer's drug by the European Commission. So they have best in class Alzheimer's data. Really like this company. This stock could be easily up 5x if they get approved sometime this year on Europe, and or if they actually announce filing in the U.S., the stock could be up 5x from where it is currently. We think that this could be a really big winner over time as they have the best in class Alzheimer's drug, has been through the clinical trial, and they're filing for approval. Already filed in Europe, and probably the U.S. will come shortly, sometime this year. Grail, the Holy Grail, okay? We've talked about this a lot. The stock has done a 180, okay? So it's back down to kind of where we started. We started around here, I guess. But down in this level, $17 is right before it took off. Okay, it had some nice positive comments by the former chairman or the current chairman of Oracle, Larry Ellison, of how this would work in detecting cancer and finding, basically better ways of treating cancer. Their testing is, I think, remarkable, and we saw the stock move in a big way from 17 to 60, and then it's pulled back. It's pulled back all the way to 22. Don't miss this stock. This is just an amazing opportunity here. Again, this company could have as much as 100 million in revenues, say, 3 to 5 years out. So they're going through their approval process. They're already getting revenues from their testing, but they're getting it rubber stamped by the FDA to get the insurance coverage. There is some insurance coverage already. That's how much the market believes in what they're doing. Crazy cheap stocks. Just keep that in mind. Buy quality, but crazy cheap. Now, we really like Gap. We think Gap will meander their way through these tariffs, but very cheap stock, margin potential expansion, still very nicely. See the operating margins continue to improve. The merchandise is much better. The comp store sales are doing really well, and it's trading at less than 10 times earnings. So that's a really interesting company. Speaking of biotech, Fortress Bio, okay, they own half of Journey Medical, Derm, DERM. This stock, Fortress FBIO, should be up 100% based on what they own of that position, Derm. But they have some other things coming too. So other things later this year, that they have a drug that'll likely get approved, and they'll get a windfall off of that one as well. High dividend yielding stocks, you want to be there. So this is a nice way of protecting your downside. So if you can get a 7, 8, 10, 12 or higher % yield on some of those positions or a portfolio. So we have portfolios that have really nice dividend yields, getting 7% roughly. A 7% dividend yield that would require the market to fall 7% more from this point. Um, we've had that bear market, so maybe we'll be down 27%, but we've required the market to fall another 7% over a 12-month period, and collecting that 7% yield just to break even. So it's a nice way of protecting your downside with nice yields. Now, these are ETFs: SPYI, QQQI, IWMI, okay, S&P, NASDAQ, Russell 2000. We really want to own the Russell 2000. Now, this ETF has a 17% yield. So they write both calls and puts, and they collect that yield, but that also tracks the upside and downside of these indexes. So it would be hard to imagine that the Russell 2000 would be off another 17% from roughly a 25 or 27% decline that it's already had. And if you want to buy, these high quality companies, the QQQI is a nice way of doing that with about a 15% dividend yield. So on Monday, we reduced some of our hedges. We bought some of these cheap dividend stocks, made sure we got the proper weightings in some of these new coming great companies. So we took advantage of what was going on. May not be exactly at the bottom, but we think that we're going to see a rally from here, and there's an opportunity to take advantage of that. So it could be more downside. We may have to reverse course a little bit. We're not fully invested, so it allows us to basically get back to even if we do have a pop, because we're not down much, but get back to even, or make some money while the market's still down in a big way versus where we are. So I really like how we're positioned, and we're taking advantage of some of that opportunity. If you have any questions, just ping me, or come to my website, Patrick Adams CFA, and sign up for a hard copy of Market in a Minute. We'll send that to you weekly. And or if you want to employ us to help you manage money or manage your money, just let us know. We'd be happy to do a conference call. Take care. Bye.